Okay, everyone, so we'll be starting in 1 minute. So if you just want to introduce yourself on the chat by saying your name and where you're coming from, and we'll be with you in 1 minute to start the webinar. Hi, everyone. Welcome and thank you for joining us all to our first webinar in the series on coming through COVID sustainably by Adam Smith Business School, University of Glasgow. This is the first in 4 webinars that we have for you that are going to be running every week for the next 4 weeks on Wednesday 12 to 1, and I'm absolutely delighted that this one is partnered with ICAS, the Institute for Chartered Accounting of Scotland, and we're going to be focusing on today's webinar on accounting for COVID-19 sustainability, impact and accounting professionals. Now, we have an absolutely fantastic lineup of panelists here with us today, and I'm just going to introduce them one by one, and I'm sure you'll be hearing a lot more from them shortly. I'm going to start off by introducing Sarah. Now, Sarah Johnson is Director of the Collaborative for Frontier Finance, and they lead a network of over 50 emerging market capital providers investing in small and growing businesses. Sarah is a qualified chartered accountant with over a decade of experience in senior leadership roles in EY in the UK, UAE and USA. Sarah has also worked with impact investors on the design and operationalisation of blended finance funds and provision of post-investment technical assistance services. So we're absolutely delighted to welcome Sarah here, both as a chartered accountant and also from that kind of expert practitioner perspective. I'm going to turn now to Anne. Now, Anna Drain, I'm sure a lot of you will know Anne from ICAS. She's Head of Sustainability and Reporting within the Policy Leadership Team at ICAS. And now Anne's role is primarily associated with the education and awareness raising of the relevance of these issues across the ICAS membership, including its student members, which I know we have a number of joining us today. And the accounting profession more globally. And she uses its ICAS's voice and global reach to influence policymakers, regulators and standard setters. So a really important role, both in terms of what we do at Adam Smith Business School, but also very topical in terms of where we're trying to go at the moment in terms of the accounting profession. I'm going to turn to Sean next. Now, Sean McGrath is a chartered accountant and he's the Finance Director of Entrepreneurial Scotland. Sean is a multidisciplined senior finance professional, and he has a wealth of experience in both a practice and a commercial setting. His specialism is in change management, and he's a passionate advocate for entrepreneurial thinking, having worked with and for a number of entrepreneurs for a number of years now. Now, previous to joining Entrepreneurial Scotland, Sean has held financial management position roles across organisations including Deloitte and London and Scottish Investments. And prior to retraining as an accountant in 2011, Sean spent several years working in commercial roles with brands such as Red Bull, Northgate Arinso and Monster.com, where he was responsible for driving sales and marketing activities. And then finally, I'm going to turn to Dr. Yingru Lee, who is a lecturer in financial accounting, tax and audit here at Adam Smith Business School at the University of Glasgow. She's co-convener of the Glasgow Human Rights Network and also has expertise in reporting initiatives and accountability practices and how they could be improved to enable business to better comprehend global challenges such as sustainable development goals, businesses and human rights issues. She's currently working on a funded project that examines whether, and if so how, national human rights institutions could help to embed the UN guiding principles on business and human rights in the private sector. So welcome Yingru, Anne, Sarah and Sean. I'm absolutely delighted that you've been able to join us here today and for what's sure to be an exciting and robust discussion. So what we're going to be doing today, just for those of you who have joined us, we're going to start with a panel discussion of about half an hour, where we're just going to be introducing some of the key aspects surrounding the accounting profession and professions more broadly. And what does that actually mean in terms of accounting for COVID? Is this a moment for creativity, for opportunities to rethink how we consider sustainability in accounting? And that's sustainability in all its forms, in terms of resources, in terms of people, and in terms of the future of successful organisations? Or is COVID-19 going to bring a series of marginal activities where we see these issues put on the back burner? And if so, how can we prevent that happening? So I'm going to first kind of kick off by saying it's probably fair to say that we're really in unprecedented times for the accounting profession, or those of you that are involved in accounting in organisations. And I wonder if I could turn to Sean first to ask, what are some of the practical challenges that you've had to face during this period?
Thanks, Kathleen, and thank you also for the invitation to come on and join the discussion. Really delighted to be able to take part. There's been any number of practical challenges and issues, as I'm sure you can imagine and everyone can imagine, over the last few months. We set out our budget as an organisation, just from our own experience. We set out our budget in November 2019, and we were facing our best, strongest year ever in the market, and we were just thrilled, really looking forward to 2020. Even up as far as February, everything was looking pretty smooth. There was issues around the world, but nothing that seemed like it was going to impact us here. And then in the matter of, not even months, in a matter of weeks, everything was turned on its head. We lost 80% of our revenue streams just like that at a key point in time for us. So we faced a huge number of challenges. I think probably the biggest challenge from an accounting perspective that we faced is we've always dealt with uncertainty. Everyone that's involved in accounting and in any way, shape or form will be used to uncertainty. But that uncertainty usually occurs within a kind of a quantum. So you can say, look, I'm not sure if it's going to be between 20% or 30%, but I know it'll be somewhere in between. But the reality really of the last few months has been that you don't know if it's going to be 0% or 100%. It's the quantum of that uncertainty has just stretched so far. So I think, for us, in my experience, where accounting was very much a science up until February, it's become a bit of an art between March and now. So you really have to start thinking about things that aren't part of the numbers and aren't part of the books. And that ties in beautifully to what we're discussing today. And that's why I think, in our experience, when we started to look at our forecasts and we started to look at our assets, we started to move away from what our physical assets were and started to look at what are our kind of underlying intrinsic assets. So things like our people, things like our reputation, things like our standing in the market. And those are the things that in actual fact will actually see us out the other end of this. So it's been an enormous learning curve for us. It's also been an incredible period of reinvention. And as an organization that promotes and supports entrepreneurial thinking, we liked to do a bit of it ourselves, but we were never in a position where we've had to do as much of it as we had to do in the last few months. So it's been an opportunity to really flex that creative muscle. So yeah, again, forecasting, dealing with the uncertainties, trying to understand what your real assets are and what it is that will drive your performance going forward from this point. And of course, cash and cash flow have been the biggest practical issues that we've dealt with.
And I saw you nodding vigorously, Anne, as Sean was talking there. I wonder if I could just turn to you from a accreditations perspective in terms of the purview of accounting and what you've seen as some of the main challenges. Oh, if I could just ask you to unmute.
Sorry, I thought I'd missed the button. I should be used to this by now, really. Yeah, thanks, Kat, and thanks for that, Sean. And ICAS, I suppose we have a couple of different perspectives because we're an organisation in our own right, but we also are a member professional body and serve our members and students. So if I could quickly sort of talk about some of those two perspectives, and much of what Sean has already mentioned, I think most organisations would recognise and say that they experienced the exact same thing. Suddenly we hit the 17th of March, lockdown hit in Scotland, and everything changed. Everything got turned on its side. Everything we had planned for 2020 had to be completely revisited, and not just in terms of the financials, but also our service levels and our service delivery. And it was important for ICAS to be seen to, as much as possible, continue to deliver the same level of service to both our members and our students, but equally ensure that our staff could continue to do their job and fulfill their commitments and responsibilities as part of that service delivery. So the whole shift towards a digital and virtual way of working became core and the core kind of objective for us to do very, very quickly, and it involved a lot of effort and a lot of soul searching and teething problems to enable and make staff comfortable with this new way of working, and not just getting to grips with the technology, but also the getting to grips with being in a remote environment, isolated from the members of the team, where you don't have that peer support. So it was that there was a lot of focus put on during the initial period to ensure that our staff were entirely comfortable and felt supported by the organisation. And additionally, our members were facing huge amount of uncertainty, as Sean has already alluded to, some facing some severe financial pressures. They'd seen their income streams completely disappear in a matter of weeks, and we're looking to us as a professional body to try and help them navigate through some of the government support measures and support packages, and how we might assist them and help them as part of that process. So it really emphasised the role and the reliance that the accounting profession has for an organisation and in the business environment to ensure that businesses have the ability to continue to operate and to survive and adapt to become much more resilient. And from the ICAS reputational perspective, we wanted to be seen to continue at the same level, or as much as possible at the same level as we had pre-lockdown. And a large part of that is the education of our ICAS students, many of whom were at various stages of their training. And it was really important to ICAS that they were able to continue with their professional careers as far as possible. So we had to make a massive investment and in the technology and the support and software that would enable the online teaching provision to continue, much the same as probably occurred within the university itself, and also the shift to an online exam process, which we've trialed on several occasions now, and I think we're gradually becoming more comfortable with that. and we felt that it was important to give our student members that kind of certainty that they could continue to progress. So the different challenges that we've really experienced, I think we've been able to tackle. It's taken a bit of time. It's not always worked first time, but we are learning it, and we are adapting, and what the future might hold is completely unclear. As Sean has said, there's no definitive answer, or nobody has a crystal ball as to exactly how the economic outlook might turn out. And so we're still receiving a lot of questions from our members in terms of the support that we can offer. And I think it's the availability of us as a support mechanism has really enhanced the relationship that we have, and built on the relationship we have with our members as well. So while there have been challenges, there have also been some positives, but we do seem to have shifted away from just the financials and how we actually account for some of these things, and think about some of the more intangible impacts that COVID might have, and staff well-being, and the reputational maintenance of our standing has been absolutely paramount as far as ICAS is concerned.
Yeah, great. I'm aware of something that just struck me when Sean was talking. He said that almost overnight, accounting turned from being a science to an art. And I guess one thing that COVID has taught us is that there's no best way of measuring in some way, and that the numbers don't tell us the whole story. I was wanting to focus a bit more on that kind of idea of, the numbers not telling the whole story, to think about the idea of accounting for impact, and turn to you, Sarah, and think about how you see the challenges, or some of the opportunities, if we start thinking about, this kind of going beyond the numbers when we're thinking about accounting for impact.
Great, thanks very much, Kathleen, and thanks to the fellow panelists as well for their comments so far. So as Kathleen mentioned, my name's Sarah Johnson, and I work for the Collaborative for Frontier Finance, which is a multi-stakeholder initiative seeking to drive more capital to small and growing businesses in emerging markets. And we define small and growing businesses generally as businesses with financing needs of between $20,000 up to around $2 million. And you might have heard this referred to as the missing middle. So generally companies that are too large for microfinance, but perhaps too small or lack the track record to benefit from traditional investment or bank financing. And what I do with the collaborative is work with a network of financial intermediaries. So these are fund managers usually that are investing in these small and growing businesses. And we have a network of around 50 of these capital providers in emerging markets. And one of the challenges that they have is raising finance to be able to invest in these businesses. And what struck me at the moment, particularly with the impact of COVID, is the diversity of the financial returns that these capital providers are forecasting. So, there's a real range, everything from pure market rate returns that you might get with a mainstream investor, all the way through to very concessionary returns. And that can be warranted if there is a strong case for impact. And what we're also seeing is currently an appetite from funders to be providing capital that perhaps isn't purely tied to financial returns. And this is evidenced in the number of COVID relief programs that we're seeing around the world at the moment. So, I really think that COVID has emphasized this trend that we've been seeing towards environmental, social, and governance, or ESG investing that's been gaining in popularity over recent years. And COVID's really reinforcing the message that financial returns aren't the be-all and end-all of performance metrics. And as Sean and Anne have just said, earlier on, there are other intrinsic sorts of measures that may be more applicable. So I think, really COVID's challenged us to think, well, what use is financial returns if you're not looking after your employees' health and safety and well-being? If you're not providing PPE and your employees all contract COVID, well, what use are financial returns in that context? And I think what's really important is that the capital providers and portfolio companies out there, they need to be able to articulate this impact that they're having. So it's not just financial returns, it's other things as well. But how do you do that? How do you actually articulate and measure the impact in a way that's comparable across perhaps different sectors? So if I looked at two companies, maybe one that's providing solar lighting products, let's say, reducing the use of kerosene and therefore measure their impact in terms of reduction in CO2 emissions, how could I compare them to perhaps a business that's in the agricultural space, that's working to aggregate production from smallholder farmers and maybe measures their success in terms of the number of smallholder farmers that they reach and the improvement in the livelihoods of smallholder farmers? It's very difficult to compare and contrast those two types of impact. So what I feel is that we're seeing a lack of consistency and a lack of comparability on how we actually measure and quantify impact, so that we're all speaking the same language.
I think that's a really important point, Sarah, and I guess I'll turn to Yingru here, because I think it's a really interesting question, and perhaps one for research. You know, how do we articulate the different types of impact, and we're able to compare these across organisations and sectors? Is there any kind of emerging best practice or approaches that you see working there, Yingru?
Thanks very much. Thanks, Kat. And it's my pleasure actually to be on this panel and also contribute to this very exciting topic on connecting accounting and sustainability, and also with COVID. Before I actually answer your question, Kat, I would just start a little bit, approach the question a bit different. So before we start to think about how we can compare the impact or how we can create indicators, I think one thing I want to put forward is we need to be very reflexive and careful about what we are trying to create. So what kind of a measurement that we are trying to put out there as a way to measuring our impact. I think in the past few months, we have actually seen a very vivid example from the government of showing us how they are problematic of actually trying to hold themselves to the promise, for example, how many tasks they're going to do per day. And that they set themselves a measurement, a target, and then they are being painful of actually being trapped in that target. And I think that gives us a good lesson of learning what kind of the target that we put forward and how we're going to measure against that target. So for example, I think if we're thinking about that a company is aiming to reduce the number of complaints for the next year as minimum as possible, it could possibly that we would see that there is a reduction in the number of complaints in the sustainability report at the end of the year. But what we do not see is behind the scenes, how they actually measure it, how they interpret the complaints. Will they actually interpret the complaints in a very different way or in a narrow way? So some of the complaints that used to be thought as abuses is no longer appear on the report. And with that kind of interpretation would actually distort the way or the good initiative that we want to hold the business accountable. So I think and then when we come to the idea of compare, so I think we need to be first to be aware of what we are creating to measure, what we are measuring against. And then we start to think about being quite reflexive and also critical about the outputs, the outcome, like the indicators, what measurements we have created. And now we come to your question, Kat, about what are the innovations or the examples, good practice there. Yes, they are. There are a lot of emerging practice which has been created. So for example, I think PwC have created something called TEAM, which is trying to measure about several dimensions of the impact, like the social dimension, the environmental dimension, I think is called total impact measurement and management, so it's called TEAM. And there are particular standard board which emerging, like sustainability accounting reporting standard board. And not to mention there are integrated reporting, which is also being proposed several years ago, actually led by Prince Charles, which is trying to create or trying to rethink accounting, how it can play a key role in the bigger goal of this being sustainable economy. There are some other protocols like social human capital protocols, which is built on the model of natural capital protocols, trying to provide a methodology for the company to identify ways to measure and value social and human capital. I think Sean has made a very interesting point of this conception or perception of accounting actually moving away from this accounting as a science, which I think accounting is no longer a science, and accounting actually and now is moving towards how we actually account for the uncertainty, how we actually account for the bigger challenges and the issues like human rights, how we account for labor issues, how we actually make sure that we account for the people. We're not just simply account for the kind of the outcome that is going to impact on business, but also we are trying to account for the impact on people. And I think that's kind of the lessons we need to draw from this whole experience of COVID, and also taking this as an opportunity to rethink and reflect and trying to think about what we are creating and what we put forward, and be critical about the measurement and indicators that we're suggesting, and always making it being changing and evolving, and not to be kind of stigmatize it or trying to be hold onto it. So that's me. Thanks very much.
That's great, Ingrid. I think that's a really interesting idea of the sea change from accounting in a traditional sense to accountability and to call to account. I wonder if you had any thoughts on that, Sean?
I do, actually, Kathleen. Thanks a million. Ingrid, I couldn't agree more with what you're talking about. And I think not only from my own experience, but in terms of, just to give you a little bit of background, Entrepreneurial Scotland is an organisation. We work to help Scotland unleash its entrepreneurial potential, and we do that in a couple of different ways. And one of the ways we do that is to work with businesses and senior business leaders and help them to progress on their own entrepreneurial journey, so that entrepreneurial leadership is there to help drive forward the businesses. And one of the things we found on our own organisation, and one of the things we found through discussions with senior business leaders, is that very much as the balance sheets and the P&Ls have retrenched, almost like the sort of tide going out, it's helped them to not so much focus on those numbers and actually focus on what's underneath those numbers and what's within the businesses. So again, things that we talk about like staff, impact, sustainability, stuff like that. And it's helped them to understand just how important those things are in supporting the numbers that they report. And to give you an example, in our own situation, we've always been blessed with incredibly dedicated staff because they believe in what we do. But this has never shone more than it has through COVID, and through what we've seen our staff do for us, and through the resourcefulness and the sheer drive in entrepreneurial thinking and coming up with new ways of supporting the organisation. And a number of different organisations, both large and small, have reported exactly the same thing. They've reported that this has helped people to lean into the business and to actually put their shoulder behind it. And senior leaders are now starting to understand something that should have been, very evident to them all along, that their best resource is their people. And it's helped, I think, that a lot of accountants are now really starting to bring that forward. And I think accountants have a huge role to play in that. In fact, I would go so far as to say that we are integral, because senior business leaders will use the information that you produce to make decisions. So you are a gatekeeper for this information. And it's important that when you put this information together, that you exercise your own judgment in terms of what should go in and what shouldn't go in. So you need to be mindful of including things that, okay, yes, we can reduce spend by X% by, cutting this or cutting that. But what are the follow-on impacts of that? So the impact on morale. And what's the impact on morale? Well, it means more recruitment. And what's that in cash terms? Well, it means this. And so you have to think through all the steps of the various actions and present those for senior leaders to digest. They won't necessarily interpret and understand all that information itself. And the other thing I would add to that as well is that we've seen, not just from COVID, but actually over the last kind of 2 years, we've seen a wave of new organizations coming through, the likes of B Corp organizations. If you've not heard of B Corp, that's more sort of profit for purpose and signing up to that. We've seen a wave of organizations come through on that, and they don't view sustainability and impact as something that they're doing for the world because it's good to do. They do it because it's business sense. and there's money to be made doing it, and it's a profitable venture. And we see an awful lot of investors that are looking to support organizations like that, because you know, Sarah, I'm sure you'll find the same, that not every investor is involved purely for financial returns. Financial returns are important and key, but most people invest to stay connected to business and to back things that are important to them. So, you know, the rise of impact accounting, I think, is enormous, because it can be the very thing that secures the investment that you want, much more so than your strong balance sheet or your strong P&L.
Is that something that you're finding? If I turn to perhaps Sarah and then Anne, is it something that you're finding in terms of the kind of investor? Perhaps we underestimate what the investor wants, or we misinterpret actually what the investor wants, and that in turn affects accounting.
Yeah, hi Kathleen. Yeah, absolutely. I think we are seeing investors with a range of different interests at this point. You know, as I mentioned before, ranging from market rate returns all the way through to very concessional returns where there is deep impact. But one of the nervousnesses that I have about impact and investors that target impact is that there can be firms out there that undertake what's known as impact washing, where they claim to be having impact, but they're not really having impact. And I sort of think that, you know, that can be misleading. You know, we see a lot of companies with great statements emblazoned on their websites, but with very little substance underneath it all. And it was great that Yingri was alluding to some of the different measurement frameworks and resources and tools that are out there. But I think one of the challenges we're facing right now is there are a huge variety of impact measurement tools. The Global Impact Investing Network, or the GIN, have developed the IRIS standards, the impact reporting and investment standards. And I think they've just released IRIS Plus recently as well. So there's another upgrade that's come out. The B Corp that Sean had mentioned had released a set of standards called the Global Impact Investment Rating System, or GEARS. And then the Global Reporting Initiative have GRI. As Yingri mentioned, there's SASB, the Sustainability Accounting Standards Board, with their standards. And then individual companies, for example, the Acumen Fund, based out of New York, had developed their own methodology called Lean Data, which they've recently spun out into a new entity called 60 Decibels. So there's just so many ways and frameworks and tools that we can use to measure impact. And we're struggling to gain consensus as to what the right framework is. And my nervousness is that this allows organizations to really cherry pick the methodologies that show their investments or show their portfolios in the best light, without really having the kind of, you know, real granularity and real comparability across industries and across geographies. So I think that it's tricky. There's not necessarily a one size fits all approach. Although one approach that has been suggested is monetizing impact, so creating a dollar value for impact and using that as a mechanism to compare impact across industries. But this is really tricky. I mean, if I go back to the examples I used before, how do we quantify a reduction in CO2 emissions? How do we quantify an increase in farmers' livelihoods and monetize that? And then in the current COVID context, where there's clearly a lot of interest and activity in the healthcare sector, how on earth do you quantify the value of a human life and have a neat debit or credit to put into your accounting system? So I think the measurement question is something that will stay with us for quite some time.
Yeah, absolutely. I mean, it's a dizzying array of acronyms that you mentioned there for anyone trying to navigate the territory. I wonder if I could just turn to Anne to ask, in terms of, you know, ICAS's perspective and your kind of role in particular, how on earth you help accountants navigate their way through this variety where, you know, you have, I guess, on the one hand you have the impact washing challenge, but on the other hand you have people that with the best intentions are trying to do something but actually find themselves lost or even contradicting their aims in attempting to do that.
Yeah, I mean, there have been some interesting points raised by all of the other panelists there, and the accounting professional has got a key role here, because as Yingru and Sarah both mentioned, it's not just investors but other key stakeholders, your staff, your customers are interested and want to know this information. And yes, investors are probably the key stakeholders as the providers of financial capital, but equally important are these other stakeholders, and how can they make a comparison or benchmark you against another organisation when there isn't that standardised format and framework, and there isn't really any clear indication of the extent of the rigour or the interrogation that's been undertaken on some of these figures. And I think that's where the accounting profession and finance professionals can really add some value and contribute towards that enhancing of the trust and the confidence and the credibility that users of that information can have in what they're being provided. And increasingly, I mean, we're seeing more and more, and it's based on to a large extent investor demand, but also societal expectation as well, that organisations have to demonstrate more and more that it's not just a tick box exercise, that they've not got CSR or sustainability or however they term it as an add-on. It's core to their business model, it's core to their strategy, and they're incorporating all of these social and environmental perspectives within their strategy. And we're seeing more organisations start to think about how they go about this in a serious and effective manner, so that those that want to work for that organisation or want to trade or buy from that organisation. I mean, just think about some of the consumer expectations now when you think about the supply chain considerations. We all want to have confidence in the information that's being provided about an organisation's ethical, social and environmental stance, and having a professional that's trained in actually gathering that information, analysing it, interrogating, and then producing it in a format that is consumable, understandable, and backed up by evidence, is something that the accounting profession, we do that as part of our core skill. I do think that there needs to be more training of the accounting profession in some of these other areas, as far as the recognition of the importance of some of the environmental and social factors, and the impact that these can actually have on the organisation's finances and ability to remain future proof and adapt to a changing environment. So I suppose I see the accounting profession having a key role. In terms of my role and ICAS, yes, there's a whole alphabet soup of standards and frameworks out there. There isn't a common sort of recognised or acknowledged standard, but that we are moving, I think, towards a more homogenised reporting environment. We see that in Europe, certainly, where the European Commission are looking at the non-financial information landscape and how that might look. We see the international financial reporting standards starting to place more interest on the non-financial reporting side. So I think we are trying to move towards that more standardized and integrated format of reporting. Okay, it might not be the integrated reporting that the IIRC we're proposing, but there's a recognition that you can't isolate the numbers, that actually the other narrative information is needed to give some context to the numbers.
That's really interesting, and especially what you mentioned there in terms of the future of accounting, you know, in terms of, not in terms of just the post-COVID epoch, but also people coming through accounting. And I wonder if I could just turn to Yingru, who I know, you know, teaches would-be accountants and future accountants on a day-to-day basis. And do you see that is there an appetite for this, or is there still some tension between what might be seen as quite traditional approaches to accounting vis-a-vis thinking about accounting for impact in a more holistic sense?
Thanks, Kat. Well, certainly I do think there is a growing interest in our students actually being thinking a bit broader about what accounting and what kind of accountants they want to be in the future. I think that's key. We should not forget that our students now, they're in a generation that already being exposed to internet. They're considered a generation which they're keeping up with all different issues like social issues, environmental issues, politics. So they have an idea of like, they do not want to just be accounting as so-called a bank counter or bookkeeping or some kind of this doing the kind of the calculation. They want to be someone who actually can do multiple things. They want to be someone who have a bigger agenda. And I think that's key, and that's very relevant to their growing interest now. I can see in our students, they're picking up courses like interest in human rights, in social and environmental accounting, in there's a broader agenda to critically rethink about the accounting role in every single part of our life. So accounting is not just is constrained in a business setting. And I think one thing we've actually talked about is we also need to rethink about the role or the purpose of the business as well. I think that's the right time, or actually it's been going on for a long time, of what's the purpose of the business? What is it for? Just for the shareholder interest? Is just for the financial return? Actually, the business itself carry a stronger perspective in contributing to the public interest for the bigger role for the society. And to really align with that, I think accounting also needs to think about itself, how it can serve a business which wanting to serve that role in a bigger, in a wider society, and how we can actually to integrate and embed those considerations about how it's going to impact our people, how it's going to impact on the community, into our daily practice, like into the reporting practice, into the daily business of a corporation. And I think there's, I can really see this is how we should encourage, and this is also what our subject has always been doing, is to encourage students being always to thinking out the box and trying to be critical and being reflexive about what they're doing and what accounting should be, what accounting is, and what accounting is providing in a general sense, what the role of accounting in a society. And I think that's a key question, and also for students to pursue as their own career as well.
And would you say that's the view from the coalface, so to speak, as well, Sean? Or is there kind of also the tension between some of the kind of pressing challenges you have at the moment? So I know that one of our attendees, Isabel, mentioned, the idea that there's a lot of practical challenges, such as, she mentioned reviewing office space requirements that are becoming kind of key accounting issues that need to be addressed now. So what's the kind of feeling from the front line, so to speak, would you say, Sean?
I mean, it's very clear from the conversations that I'm having with businesses and business leaders that first and foremost in every senior leader's mind up and down the country is protecting the jobs of staff. I think right now, everyone's worried about returns on investment for their investors, but if you really get down to it, I think the vast majority of senior leaders are worried about their people, and they're worried about trying to hang on to as many of them as they can. And that will have a tendency to drive more focus on the numbers, and you will find that there are some leaders out there who don't quite get the concepts that we're discussing at the moment, and they still view sustainability and impact as a nice to have, or they sort of put it in the marketing slot up beside social media as something that the kids do and that we should probably do too. And then you've got the more forward-thinking leaders who are, who understand just how critical it is now to business and how important it is. So I think first and foremost, for the vast majority of business leaders out there right now, and accountants working in industry, working with organizations, their key concern is, protecting the resources and protecting the staff of organizations. But by the same token, the wily ones will have their eye on the opportunity that's arising from this. So, for example, recently we had some discussions around, what's going to happen in terms of offices and returning to offices, and what are people thinking and what are they talking about. And most organizations were pretty free in admitting that they didn't think they'd be able to get their staff to come back full-time to the office. And a lot of organizations that were, previously maybe reluctant to go down that road, COVID had forced them into doing it, and they had learned, well, actually, we can trust our staff to work, and our staff prefer to work in this type of setting. But at the same token, they know that their staff don't want to work at home full-time. So everyone, I think, recognizes that they will be able to reduce the amount of staff they have in, therefore reducing square footage in their office, which, as a finance director, I can tell you is one big cost that you don't want to have. So if there's anything that can reduce that spend, then more power to it. So you'll find that people will be looking at the opportunity, saying, well, great, we can drop a floor. Clydesdale Bank, for example, Virgin Money have dropped an entire floor at their new office that they've taken out in Glasgow, and told a third of their staff that they can work from home permanently now. But what they're doing is they're taking a portion of that saving and they're reinvesting it in the other two floors to make it a more attractive, better place to come. So they want to make a saving for the benefit of the organization, but they also want to create a space that's more of a hub and that's more enticing to people to come into the office. Because being in the office is where you get that unplanned interaction and where you get an awful lot of the invention and the creativity that comes out of organizations. So I think people are recognizing the opportunity in it, but by far, they will be very focused on what they can do to try and protect resources at the moment.
Fantastic. I'm aware of some questions coming through, and time flying as well. So what I'm going to do now is just open up to question Q&A, and if anyone has any questions that they'd like to make, please feel free to put them in the Q&A here. What I'm going to do is I'm going to turn to one of our attendees, Craig McKellar, and I'm going to ask Sarah to address his questions. So if you just, I'm just going to ask you to talk, Craig. Are you able to speak now?
Can you hear me now?
Yes, we can hear you now, Craig, yeah.
Great, so you just want me to ask the question?
Yeah, if you could just ask the question, then I'll turn to Sarah for this one.
Yeah, no, it's been really interesting. So what I'd said in the chat was really that, personally, I think, we need to get away from the message that ESG investment is only a good thing to do, which has been alluded to, can help in areas, but not in financial returns, whereas a lot of, I guess, articles and data coming back is that financial returns are positively significant when there's responsible investment. And so when thinking longer term, that makes sense. Many businesses are hesitant to really focus on the UN's SDGs or tackle climate change. And a point was raised about, companies putting out messages that kind of look like they're either being responsible or sustainable, but when you kind of strip it back, it's maybe just kind of corporate social responsibility and nothing really new. Really, my kind of question comes down to, I've seen that a lot of companies have signed up to the SB's TCFD, and I just wondered if any of the panelists had views on firms signing up to this, as I'm aware a lot of firms have, but some haven't.
Great. Can I just turn to you first, Sarah, and then I think I'll go to Anne as well after this one as well. So Sarah, please.
Great, thanks, and thanks, Craig, for your question. I think it's a really insightful question. So the TCFD, if I'm not wrong, that's the task force on climate disclosure. So that's kind of another one of maybe the list of acronyms that I was alluding to earlier, where there's just so many different things out there that people can sign up to, that they can sign on to, that they can pledge to do. And what really confuses me is what the actions are behind all of these sort of headline statements and different frameworks and metrics that are out there. And so it does come back, I think, to the measurement question, and it comes back to, is there a way that we can perhaps monetize impact and treat it as a financial metric which people are familiar with and know what to do with. And I thought it might be helpful to mention that Sir Ronald Cohen, who's often referred to as the father of social investment, he's the chair of the Global Steering Group for Impact Investment, which is a global organization. I saw him speak last year, and he talked about having generally accepted impact principles. And he said that within 5 years, we'll have generally accepted impact principles in the same way as we have generally accepted accounting principles. and they will be included in financial statements so that we can allow the users of financial statements to understand the impact on profits. And an example he gave was that you could have two companies, both making $1 million, but if one of those companies, say, was a tobacco company and was having a detrimental impact on health, then that company may have an impact loss, quote unquote, of $500,000. And therefore their profit would be reduced then to $500,000 versus the other company that wasn't in the tobacco industry, which would maintain their profit of $1 million. And so that's one way that we could start to enable comparability, and that investors could really start to see what the impact actually is on the balance sheet and on the P&L. My own view on this, and getting to this within 5 years, is that it's laudable but incredibly ambitious. I think, you know, it took the world long enough to converge on accounting standards for numbers. And even now, I mean, the US still does its own thing with US GAAP, and the rest of the world have converged with IFRS. I don't think we're going to get there overnight, but I think that it's something that we should aspire to. And I think, as Anne had said, you know, having the accountancy profession, having a seat at this table to drive that discussion forward would be great. My sort of worry and fear, really though, is that unless these sorts of standards become mandatory and that there's kind of legislation behind them, and that reporting is enforced, I'm not sure whether there'll be much of a voluntary uptake. And so, you know, whilst we have all these networks, all of these standards, all of these frameworks and everything, if we don't have legislation that will enforce it and will require companies to be reporting on some of these things, you know, it may unfortunately fall by the wayside. And so I'm harking back to, I had a 10-year career as an external auditor. And so it makes me think of that, and having auditors trained, as Anne had mentioned, in going in and verifying this information. And I sort of feel that as accountants, we really have a leading role to play in that respect, that we can verify some of this information, kind of, you know, separate the wheat from the chaff, and make sure that what we're seeing isn't impact washing, and verify that there's real impact there. So that was a bit of a roundabout answer to your question, but I hope that helped somewhat.
Thanks, Sarah. I'm going to quickly turn to Anne as well. We've got questions coming in thick and fast, so I'll turn to Anne here. Yeah,
I'll be as brief as I can, and thanks for your question, Craig. And I think the start of 2020 was seen as the year where climate change was really going to become mainstream, and with COP26 happening supposedly in Glasgow in November, there was an expectation that TCFD requirements, that's the Task Force for Climate Related Financial Disclosures, would become mandatory for the largest companies, and that would be a global commitment. So suddenly COVID hit, and everything's kind of been pushed back a bit, but there is still that appetite, and that there's still that direction. And certainly we see within the UK, to speak to Sarah's point, the UK regulatory body, the Financial Reporting Council, has already said that it will be reviewing company accounts, and admittedly it'll be the large companies, to see how they're dealing with and reporting on their climate change implications and impacts, and also the work that the auditors have done to give some credibility to those statements. So there is a shift. It's not easy. The framework is from what I hear from companies that are adopting it, it is difficult, but I do hear of more companies starting to enter into that journey, but I think it is inevitable that it will become mandatory in the not too distant future.
Great, thanks for that, Anne. I'm going to quickly turn to Dan, who asked a question, and ask Yingru to address this. Dan, are you okay to talk? If you just unmute your mic and ask your question.
Hi there, can you hear me?
Yes, I can hear you fine. Thanks, Dan.
Hi, thank you for taking my question. I had a wee question about these standards, such as the GEARS and GRI, which offer frameworks and standards about sustainability, responsible accounting, impact accounting. And I was wondering, I did my dissertation just completed in April, and I was looking at sustainability in kind of SIN companies. So Sarah, your example of a tobacco company and its effects, and whether it was promoting, say, a healthy life and what impact that had on its returns financially. And I was just wondering, I used the KSI and MLR and MSCI ratings as kind of ESG ratings, and I was wondering what value you think they can bring to this kind of discussion, and whether you think these sort of ratings could be used such as rating agencies, and with these rating agencies, and whether they need to be a kind of Moody kind of Standard & Poor and Fitch kind of arrangement, and whether that should be thought of going forward.
Thanks for that, Dan. I'll turn to Yingru first, and then go to Sarah.
Yep, thanks, Kat, and thanks, Dan, for the question. I think one of the things is there are most of this is kind of standard and also benchmark. They're created with their own methodology. So if you're and they have a particular purpose. So for example, like GRI, it was created out of a way of actually thinking how we can make the people to looking at their how they can contribute to sustainability a bit better, and how can we compare. But if you actually look close to what GRI was providing, what they tend to provide was very much like principles or guidance. They do not necessarily offer like a particular ways or treatment how you can do that. So even within the GRI framework, you would see different companies would use their framework very different ways, and then they would generate different results. So when you're trying to compile them into kind of some kind of a benchmarking or a rating things, you will need to be be a bit careful about whether that is a plausible way of doing that, because it's very much subject to interpretation, and also the idea of whether they should be integrated into a standardized form. I'm kind of in like yes and no in a sense. So on the one hand, I think I agree with what Sarah and also Anne was saying is you do need some kind of a standardized form or kind of a standardized way of actually allowing people to actually moving across to looking at different company, even if they're in a different industry, and compare them in a sensible way. But on the other hand, actually, we know how long it's going to take for such an integration, how long, in fact, for how IFRS become harmonized and it become international standard, it takes decades for it to actually become that, and also take decades for it to become endorsed and become embedded into domestic legislation. So to really have such a consensus, we're going to take years. But does that mean that before we reach the consensus, we just leave this as a vacuum and leave it untouched? I don't think so. So actually, I think it's having a different standard and have a different way where methodology is actually gives us a way of to solve the issue, but solve the issue in a way that we can compare and see which one is working better, which one is not. And in this process, we will work out a more systematic way or a better result at the end. But I think we need this process of flourishing of those standards, of this different benchmark, to give us an idea which is working, which is not working.
Thanks. Do you have anything else to add to that, Sarah?
I think just to re-emphasize the point I made earlier, that maybe some of this information needs to be independently verified. My understanding of the way that some of these benchmarking organizations work is that they'll take information from published financial statements, and so if they're audited financials, well, then that information has been verified. But it's not clear to me where they would take the information from to form a database or benchmark of impact. And so again, putting my auditor hat back on, I think that we do need some verification there before that information could be relied upon by those agencies.
Thanks for that, Sarah. We've got a lot of questions and unfortunately no time. So I guess there's a question, for example, Daniel, you suggested, is the time to introduce more courses in sustainability to Lee? I think Ingrid's question would probably be answer would be yes. Yes to that. And finally, Steve talked about he works in a local authority, and he said that their accounts are currently being audited and that the external auditors are spending a lot of time seeking assurances that the authority is a going concern, because authorities are incurring extra costs and losing income, such as from parking. So longer term, the authority is looking to release office spaces. So I guess it's probably turning to Sean for a final comment. These are the kind of operational in cutting edge decisions that accountants are having to make every day as we enter into this post-COVID epoch, Sean?
Yeah, most definitely, Kat. It's much like Sarah, I spent a number of years working as an external auditor, and my heart always goes out to auditors, but it particularly goes out to auditors this year. The going concern will be an enormous issue for anyone that's reviewing a set of accounts right now, and quite how they're going to reach a sensible balance on it, I'll be honest and say I don't know. The difficulty they're going to have is that a lot of organizations will, when they look at their 12-month forecast going forward, it's going to be very difficult for them to make any sense of that and put any store in it, and it's a real challenge. So I would encourage anyone that is an auditor that's looking at organizations out there to, don't just look at the sort of standard metrics and the standard numbers that are put forward, but try and dig into the underlying business model and dig into what it is that the organization does, and try and find some sort of support or some sort of assurance in that when you're looking at the numbers. Otherwise, 80% of organizations you're looking at won't be a going concern, when clearly that won't be the case.
Thank you, and that's sorry about that. Thank you, and that's all the time that we have at the moment. So I'd like to thank everyone for all the questions and for the attendees for joining us here. And of course, I'd like to thank Sean and Yingru and Sarah for having such a fantastic conversation with us. Of you to join us next week for our next Coming Through COVID Sustainably webinar. So it'll be the same time, 19th of August, 12 to 1. You can register at the Adam Smith Business School events page, and we'll be joined by Carolyn Curry, who's the CEO of Women's Enterprise Scotland, Janet Martin, who's a director in commercial banking at Royal Bank of Scotland, Dr. Helen Mullen from the University of Glasgow, lecturer in entrepreneurship, and Wendy Eadie, who's the managing director and co-founder of Ecom Scotland. So in the meantime, thank you very much for joining us, all of you, and we hope that we'll see you next week. Bye now. Okay, and we'll just stop the recording.